Okay, I see there's quite a lot of you now, so I think we can get started. So hi everyone, and welcome to this masterclass on private equity with Ropes and Gray. This is our first exclusive masterclass of the new year, and we've got an excellent panel today and a lot to get through. So we hope that you enjoy this masterclass and learn a lot about the practice area and the firm as well. So we always start our masterclasses with our learning outcomes. So by the end of this masterclass, you should know the fundamentals of private equity, know what the work of a private equity associate involves and how a trainee is involved in the whole process, and then learn more about Ropes and Gray and the life cycle of private equity deal at the firm. Before I hand over to our panelists, I'm just going to quickly go over some key information. So first up, please use the online question tool on Zoom to post any questions that you have, and I'll be posting them to our speakers at the end if we have time. It's also worth noting that we have a lot to get through today, so we really want the session to be private equity focused, so please keep your questions about private equity, about the presentation or the work that our panelists do. And if you have any questions about the firm's graduate recruitment process for stuff like vacation scheme and training contracts, we'll be sending out some links in the follow-up email so you can go off and take a look at that. And please note this masterclass will be recorded, and the recording of the session will be then sent to all registrants after the session, and it will be available on our YouTube channel very shortly as well. Please also do post about the masterclass on places like LinkedIn after the session to tell us how you found the session. It's always great for us at LCN to see you sharing your experiences, as well as for the panelists and the firm. We also have some fantastic events coming up over this term, so please check out the Law Careers.net events page. For example, if you're a first-year law student, we have a dedicated bootcamp session at the start of February with the University of Law, specifically designed for first years, and it will guide you in how to make the most of the year. And the session will also include 1 hour networking with top law firms. The link to register for that will be in the follow-up email, as well as on LCN's event page. And then this Thursday, we also have an exclusive masterclass with BBP University on how to actually research law firms and then make your application stand out. So I highly recommend registering for that one for everyone attending today. And we do have more masterclasses in February on topics such as legal apprenticeships and innovation, the future of law. So again, look out for those in the follow-up email and on our events page. Okay, so I'm just going to start off by asking all the attendees on the screen to answer the poll on the screen. So there'll be a question popping up any second now. So first question is, which stage are you at? And this will sort of help our panelists, to understand what stage everyone that's joining is at. So I'm just going to give you a moment or two to just take a look at the poll and answer. I see we've got quite a lot of people that are postgraduate in work, which is very interesting. And then it seems to be sort of a split between first year, second year, third year law students and non-law. So it looks like a great mix. So I'm just going to share these results. And then the other poll I wanted to run is about, how much you already know about private equity. So again, if you could please answer the poll on the screen. Would you say no, absolutely nothing, a little, a lot, or would you say you're an expert? Again, just a few more seconds, let you guys answer. Seems like majority of you are saying a little, and some of you said absolutely nothing, which is not concerning at all, because this is what the session is all about. And then we do have 2 people who said they're an expert, so we've got more experts aside from our panelists, which is interesting. So thank you again for sharing these. And for engaging with the polls, and we're sort of that out the way. And for the part you're all here for, basically, I'll pass on to our panelists so we can get the session really started. So Declan, I can hand it over to you.
Hey, great. Hi, everyone. Let me skip through. So this is just an overview of what we will cover, essentially an insight into private equity and the sort of fundamentals of a deal and how to get it done. So just a little intro to ourselves. I'm Kenan Ceylan. I'm a private equity associate at Ropes and Gray. Some time ago, I trained at a UK mid-market firm where I first got my taste of private equity, and as a junior associate moved to Ropes in 2019, and I've been at Ropes ever since. Declan, do you want to introduce yourself?
Yeah, sure. Thanks, Kenan. So hi guys, I'm Declan. And to the dismay of the slide, I'm not actually currently sitting in private equity. I'm a trainee solicitor. I'm currently sat in the investment funds practice at Ropes and Gray. But my first seat was in private equity, and then my second seat was on a private equity slash M&A related client secondment at Liberty Global, which is a big publicly listed telecommunications company. So plenty of experience so far during the TC, and looking forward to speaking to you all about the legal side of PE transactions and what it's like to work on them as a junior lawyer at Ropes and Gray.
Great. So private equity practice. So I'll give you an overview of the ropes private equity practice, and then we'll sort of dive into what private equity is and the context of the transactions and things to think about. I think just from the offset, the key thing is not really to worry too much if you're not that familiar with private equity. I definitely think it's changed a lot since I was at the sort of trainee or potential trainee or junior associate stage when I was first going into law. It wasn't as I think as it is now. Like when I first started as a trainee, I didn't really know what private equity was, and it was only in my capacity as a trainee that I learned about it. But I definitely think it's become much more mainstream in discourse, but it's not something people expect everyone to be familiar with. Understanding of the more you're exposed to it. I guess the reason it's become so prevalent now is just the number of assets that have been invested in by private equity and its prevalence in the finance sector and in corporate practices in general. And I guess a bit of an overlay about that, Ropes has always been sort of one of the firms really in the early outset of private equity. It helped establish some of the top private equity firms. Private equity didn't actually originally start in New York. It was sort of started at Boston was one of the big hubs, and Ropes is historically a Boston headquartered firm, although it's obviously now one of the top 10 largest firms in the world. And Ropes has kind of always been a part of that journey for private equity. And as a result, we represent more than 60% of the 100 largest private equity firms in the world. And we advise them not just in the transaction context, which is what I do. I'm a corporate lawyer who advises on private equity transactions, but also, as Declan is currently doing a seat on the fund side, both in terms of fund formation and advisory work, from an antitrust perspective, from a data perspective, from an incentives perspective. You know, we're a full service advising the private equity sector. And just to give you an idea of the kind of volume that we're looking at. So in 2024, I think we probably now have the 25 data, we can refresh this, but we advised on deals with $170 billion combined deal value. And some of these deals are incredibly large. The largest deal I worked on last year was a $14.5 billion private equity deal, and that was just one transaction. And obviously, Ropes is a great firm, great platform, great overview. I also think our culture is one of the things that stands out against a lot of the other kind of corporate advisory firms. And maybe one statistic that points to that as well is we're sort of unusually probably the only major law firm which has more than half its private equity partners are women. So it's just a sort of difference in terms of how we are structured and approach our work. And that's just a high level overview. We can kind of dive into the substance of what private equity is. And maybe just a little bit of a gloss over as well. So here's some of our clients, just to give you an indication. Maybe people have seen most recently in the news. We just advised EQT, which is one of our clients of the firm, who actually acquired another investment firm. So EQT is basically what they call a mega fund. It is a huge fund that has lots of different focuses and lots of different funds that they raise. And they acquired a different type of fund called a secondary fund, Collar Capital. And that is a fund that raises money to invest in private equity funds, interest in private equity funds. So EQT acquired a secondary fund. So that was the most recent transaction that was announced a few weeks ago. That's garnered a lot of attention in the industry. And that's because, like you'll see with law firms recently, and you're seeing in lots of other industries, there's increasing movement towards consolidation to build larger global organizations that do the full spectrum of investment work. What is private equity? Declan, do you want to give us a whirl through?
Sure, thanks, Kenan. So, what is private equity? Well, at its core, private equity involves investing money into companies that are usually not publicly listed on a stock exchange. So rather than buying shares in public companies, private equity firms acquire ownership stakes in privately held businesses, or sometimes they might even take a public company private. And that investment is primarily structured to be equity in nature, so meaning that the investment is for shares in the company. But sometimes, and relatively often actually, you can sometimes include shareholder debt instruments such as loan notes or even preference shares as part of the package. Now, those quasi-equity debt-like instruments sit alongside the primary equity investment, and they usually provide sponsors and like private equity firms with additional return mechanisms and structural flexibility. Now, what PE firms are looking for is typically they look for businesses with strong growth potential or opportunities for operational improvement. Once they acquire a company, the sponsor will usually take an active role in overseeing the business, working closely with the management team to implement strategic initiatives. And that might include, for example, expanding into new markets, improving operational efficiencies, maybe restructuring the business, making bolt-on acquisitions, strengthening the management team, adding people. And that's usually over a long-term horizon, right? Private equity firms will usually hold an investment for around 3 to 7 years, and that can vary, and sometimes it can be longer, and it's dependent on market conditions and the growth strategy of that particular fund. But at its core, the ultimate kind of aim and the ultimate goal is to exit the investment at a profit. A PE firm wants to invest and buy a company for 100 million and it wants to sell it for 500 million 5 years down the line, right? And that's commonly through either a sale to another PE firm, maybe it's a trade sale to a strategic buyer, and sometimes depending just what the market conditions are like and the size of the company at hand, they might even do it via an IPO as well. Now, point two aims to address the fact that private equity is almost like an umbrella term, right? It's a broad sector which encompasses several different investment strategies. So one of these is venture capital, which focuses on early stage or startup businesses. And that's often, not always, but is often in technology or high growth sectors where the risk is higher, but the potential returns can also be significant as well. And then the second is growth capital, which involves investing in more established businesses and companies which are already profitable or close to profitability, but they require kind of additional capital to expand or enter new markets or scale their operations. And there's a lot of growth potential in those kinds of companies. And then the third, which is leveraged buyouts, which I assume most people here will know or have heard about in the news, because they are usually the most popular strategy. And an LBO, a leveraged buyout, is where a sponsor acquires a company using a combination of its own equity and a significant amount of debt, right? A significant amount of borrowed money. And it's usually the assets and cash flows of the target company are typically used to support that kind of debt financing as well. And what that structure allows for is for the sponsor to amplify its returns if the business performs well, but naturally it also comes with a little bit of downside risk, right? There's an increased financial risk if the investment doesn't perform well. So, moving on to point three, who invests? Now, there's a very comprehensive list there, and I'm not going to go through it verbatim. But usually the money comes from like a range of institutional investors, and that's not always the case. Some funds will take on kind of like high net worth individuals as well. Like they don't usually make up a big part of the fundraisings for the funds that we usually work on, but it is possible that they can do that, subject to obviously getting the relevant regulatory approvals for the relevant fund. But broadly speaking, all of these parties usually invest in private equity, and the investors, and the aim, right, is that the investors commit capital to private equity funds, and that's then managed by our clients, so the sponsors, the private equity firms, and that's deployed across multiple investments over the life of the firm. Hand it back over to you now, Kenan.
Yeah, no, thanks, Declan. I think one point is just looking at those lists of people who invest in private equity, what you will realize is basically everyone in some form or another, directly or indirectly, is an investor in private equity. Pensions make up a big chunk of the investors in private equity. It provides good returns. It's still a stable investment from a risk perspective because it's still regulated, sophisticated financial investors. And so everyone, one way or another, is essentially an investor in private equity. I guess moving on to the next limb here, thinking about the role of what a private equity lawyer does, the sort of two key buckets that we think about in the context of a transaction and the work you will do as a private equity lawyer. There's the acquisition work stream, and then there's the equity work stream. So acquisition work stream is probably a little bit self-explanatory. It's the sort of private bit of private equity. So as Declan was setting out, it's the process of acquiring a company, either a pre-existing private company or a public company, and taking it into private ownership. So when we say, what do we mean by acquisition? There's two ways that you can there's two primary ways you can do an acquisition. One is an acquisition of shares. You buy the shares of a company and you take ownership that way. Or alternatively, there's an asset purchase. And so you buy the assets of a business and then you have a standalone business as a result. Often an asset purchase is quite common in the context of what we would refer to as a carve-out transaction. So where you're carving out the portion of a business from the other. So an example of one I worked on not too long ago was Dell Computers. They have a cloud software business, Boomi, and we worked on the carve-out of Boomi from Dell, and that was an asset acquisition. So the acquisition sort of tends to fall under those two buckets, more or less. And in terms of acquisition, I think the underlying point is the primary and typical investment strategy for private equity firms is control. They will take ownership and they will take control over the business, but that's not exclusively the case. Sometimes they will do minority deals, particularly depending on the size of the asset, where they will buy a minority interest. Or sometimes what they do is they will co-invest. So maybe another investment firm is taking a controlling interest of an asset, but they will co-invest and put up some money for a minority portion of that business alongside that lead investor. And sometimes they will do it as a consortium together as well. So there's not a one-size-fits-all description of what acquisitions look like, but those are kind of the main overarching ways that they're approached. In terms of the key documents that you need to worry about, the one we see most typically is an SPA, a share purchase agreement. So again, it sort of describes what we're doing here is we're acquiring shares. It's the share purchase agreement. If you did an asset sale, unsurprisingly, it's going to call an APA, an asset purchase agreement. So again, quite self-explanatory. But more often than not, we tend to structure things as share purchases. And so the SPA is what we see day to day. And that governs the terms and the conditions for the purchase. And the way you should think about the terms and conditions of a purchase is very much like if you were buying a house, you might exchange. So you sign a deal, you agree to purchase the house, and then you complete, which is at the point at which you effect the purchase and take ownership. And that's completion under a share purchase agreement. And so all of that interim period, all of the requirements, all of the mechanics are typically set out in the share purchase agreement. The other key documents to be aware of are the warranty deed, we've got the disclosure letter, and we've got the tax deed. So those are kind of the key buckets of documents to be interested in. We'll dissect that in detail next. So that was just to give you an overview. And then the next piece of this is the equity piece. And the equity piece is essentially regulating the relationship between the parties with respect to their ownership of the shares in the business. And so how to think about that is, as a private equity firm, you're acquiring a business, but you are not running the business day to day. So management will run the business day to day. And so I guess to give you an example, for example, when we did that recent transaction, which was for $14.5 billion deal, it is a global schools business. It's across 20 plus countries. There's over 90 schools. It's a massive international group. That is one of the investments for that fund, for that private that's one of the investments of the Asia fund of the EQT private equity group. So they're managing a lot of investments across multiple funds, across multiple jurisdictions that all sit under the umbrella of a private equity investment group. As a result, it's management who run the business, and the private equity will choose the right management. They will invest in good management and encourage them to grow the business. So management are a critical part of managing the day-to-day business. As a result, management will hold shares in the company as a way of incentivizing them to grow. And there's two buckets that falls into. There's the institutional strip / rollover, and then there's sweet equity. So what do we mean when we say institutional strip? Institutional strip is effectively the ownership shares of the business. Sort of think about it, if you were on Trading 212 or something and you were looking to buy shares in a public company, it's effectively that exercise is the exercise of owning a stake in the business. Those tend to have value, and they represent the value that's being acquired at the point of acquisition. And when you hear a reference to rollover, what that means is often if there's a management team who will be part of the business, and often they already own shares, maybe it's the founders, maybe it's late stage management, a CEO, CFO, CMO. As the private equity firm acquires the business, they will want to keep the management on, and the management will want to get some return from that recent acquisition. So a portion of the proceeds will go as a return to the selling managers, and they will get some money back, they will get some liquidity, but they are expected to roll over a portion of their investment into the new structure. And the reason is they should have some skin in the game. They should also want to hold a stake in the business that they are part of running, and it also provides a return for them. Secondly is the sweet equity piece. This is effectively sits at a hurdle in relation to the value of the business day one, and the shares are worth nominal value. They're essentially worth nothing day one, but they increase in value as the business grows. And the way that's designed is it's designed to incentivize management to grow the business. So that's why it's called sweet, because it's literally there to incentivize. Sometimes there's a reference to sweat equity in certain jurisdictions, which is maybe a cultural difference, but the key point is it's there to put management to work and they're there to participate in the upside. Therefore, the overarching point is that management will hold shares and the private equity firm will hold shares, although ultimately the private equity firm will typically retain control. So you have equity documents that govern the relationship between those shareholders. The other thing they do is they provide positive obligations, but they also provide negative protections. And that means that day-to-day, management of the directors, they're running the business. The controls that are put in the governing equity documents ensure that it protects the private equity firm's investment, because there's a handful of things the management can't do without the private equity firm's consent. So for example, if I'm the chief executive officer, I can't open into a new market without the private equity firm's approval. I can't incur loads of debt without the private equity firm's approval. I can't change the nature of the business without the private equity firm's approval. So all these controls that are put in place, because actually it's the management who run the business day to day, that are protecting the private equity's investment. Similarly, there are protections to also protect management. If I'm the private equity firm and I have the controlling interest, what I could do in theory is issue loads more shares, flood management out, dilute their interest, and seize even more control of the business, and really dilute the value of the existing management shareholders. Particularly when you think about the relative cash that a private equity firm has to utilize for these kinds of strategies relative to management. So again, the documents also protect management against the kinds of things that a controlling shareholder can do, and it will regulate the ongoing relationship between them. Key docs to think about. One is the management equity term sheet. Usually this is relevant in the context of the bid stage of a transaction, which we'll dip into. So you're reviewing an asset, you're thinking about whether to buy it. As part of that, you typically have to mark up documents that you submit with your bid. So the bid doesn't just include, this is how much I'll pay for the company. It also includes the terms of that purchase. And similarly, as part of that, you'll also include the terms of management equity going forward. And that's quite heavily negotiated. So that's relevant more at the bid stage. And then what you will often have in relation to that is something called an equity wrapper. And what that will say is, once we've signed the deal, but we haven't closed the deal yet, in that interim period, we will draft the long form equity documents in accordance with this agreed term sheet. So once we've agreed the terms of management equity, we will use the intervening period to put the long form documents in place. And the reason you sometimes do it that way is, frankly, transactions move really, really quickly. Equity documents are complicated and heavily negotiated. And so everyone wants to move quick. Everyone wants to secure the asset. Everyone wants to get to signing quickly. And then they can use the time between signing and closing to put the equity in place. And one thing, just to recap about the time between signing and closing, sometimes you do that just to accommodate logistics and timing delays. Sometimes you have to have a split between sign and close because there are external approvals you need. So competition clearance might be required before you can close the acquisition, or regulatory clearances that might be needed before you can close the transaction. So there's a host of reasons why you might have a split sign and close, and it's in that intervening period often is when we, in practice, often put the equity docs in place, but not always. Sometimes we have to have them in place at signing, and the terms have to be agreed and drafted in detail at signing. Each deal runs its own way. What are the two docs here that are really important to think about? We have the investment agreement, also referred to as the shareholders agreement. It's essentially a contract between the shareholders, and it establishes the rights and obligations between the shareholders. And why it's important that it's a contract between the shareholders is the recourse for a breach of a shareholders agreement is damages. It's a breach of contract. The articles are different. The articles are the constitutional document of the company, and they govern the internal affairs of the company. And they act effectively as a contract between the company shareholders and between the shareholders and the company itself. And the difference, therefore, is if you act outside the provisions of the articles, it's ultra vires, it's beyond powers, it's void. So you can't act outside the powers that are permitted under the constitutional document of the company. Other key thing to note is that the articles are public. All companies in the UK essentially more or less have to file their articles at Companies House, so they're viewable by everyone. Whereas the shareholders agreement, the investment agreement is a private contract and you don't. So a lot of the interesting terms will tend to go in the shareholders agreement. That being said, there are certain things you would think you wouldn't want to put in the articles because it's public, but because you want to make clear that those are the rights that attach to the shares, and therefore a breach of them is a breach of the constitution of the company, you will put them in the articles so those rights are entrenched. So that's the primary split between those two. Preliminary considerations. So understanding a deal, why someone does a deal, why they're interested. It's sort of an overarching, everything we do as a lawyer is in a kind of commercial lens. We advise on the acquisition and sale of companies, but ultimately clients are making commercial decisions about whether to invest. So the first thing you always want to try and think about as a lawyer is, okay, understanding the deal. Commercial drivers, why is the client doing this deal? Because that will impact how you approach the deal. So Declan gave some examples earlier. For example, a bolt-on transaction. So if your client already owns a big group and maybe they want to add a smaller asset to that group to grow the business. So for example, maybe they own a group that's really, really prevalent in North America. They want to expand in Europe. There is a business in France that's up for sale. So you're helping the client acquire the asset in France and absorbing it so they can build a much larger global business. So things that you might want to think about when you're reviewing that company is there scope for synergies? Is there scope to, is there customer overlap? These will determine how you assess the business. And so understanding why the client is buying the business will help determine the things that you should focus on and look at as part of diligence. Other things to think about, relative bargaining position. You often hear a lot of reference to whether a process is competitive or not. And the main reason people care about whether a process is competitive or not is it will really impact how you approach your markup of the documents and how you negotiate the terms. If there are lots of people interested in this company, it's very oversubscribed, it's a very competitive process, you will be less pushy on your legal terms because ultimately everything you do is a commercial negotiation backwards and forwards. We always want the ideal legal position, but the reality is you have to think about the things that matter in the context of a competitive deal. So if it's a very competitive process, you focus on the things that are most important and critical and negotiate those. You don't try and win and fight every single point and lose out on the asset because someone else was more accommodating. So that impacts how you approach the deal. And then timing pressures. The more competitive a deal is, the faster it moves. And that's because the longer something takes, the more likely the deal is to fall through, or the more likely someone else will come in. So the faster you can do a deal, the more likely the higher certainty to complete the deal. And therefore, in a competitive deal, things move very quickly. And they can move very, very quickly. I mean, we've done deals where the final bid went in on Tuesday, and by Friday we signed the deal, and you basically just run throughout the clock just to get it done. And it's all doable if everyone, and people are usually pretty sophisticated, so you can get there relatively quickly. Understanding the target is also really, really critical. It helps you determine the things that are important to look at and assess from a legal perspective. As a transaction lawyer, we're not operating in a vacuum. If there's a business, for example, maybe it's in the tech sector, IP is going to be really, really critical. Maybe it has hardware. So do they have all the trademarks and patents in relation to the hardware? Maybe it's a very consumer-heavy product as well, even though it's a tech business. So IP, branding, all those all protected. If those are things that are critical to the value of the business, those are things you're going to focus on making sure that as you review the business, that they have all the agreements they need to have in place. They've registered all the rights that they need to register in place. And so understanding the things that are important to the value of the business will help you decide where you apply your energy in assessing the relevant things that are there to ensure that the business has what it needs to operate day one post-acquisition for your client. Financing, Typically, there's a mix of debt and equity in most of these deals. So equity is effectively the client using cash to acquire shares in the business. Debt, as it suggests, you go to a lender, you get leverage, and that will help you buy the business. The key thing from that perspective is you just need to think about it from the outset. It will impact the terms and timing of the deal. One thing you will hear about a lot at the moment is reference to refis. So usually if a private equity firm has owned the company in its previous ownership, they will have used some form of debt to acquire the business or fund a portion of the acquisition. So there will be existing debt in the company. Often what a private equity firm will now do, instead of getting new debt in place, which can be timely and difficult, they will effectively buy the business, taking on the existing debt, and then they will subsequently refinance the debt on more suitable terms, post-acquisition. So that is an approach. And all of that impacts timing. All of that is a reference to what the good financial terms are for the client. So all of this operates in a commercial context. Timing of signing and completion. This is just a nod to the things I was talking about earlier. Regulatory consents, competition consents, sometimes material customers. They have protections in their customer agreements and you need their consent. If they're a huge portion of the revenue of the business, that's something maybe you want to reach out to and get their agreement that they are happy with the deal to go ahead, and then they're happy for there to be a change of control so that you continue to have that business post-closing. Employment rights. So often in jurisdictions, there might be a consultation that's required with management, or they might have a works council or a union rights, and you need to work with those. And all of those, the underlying theme is usually there. You can work around them. Usually they're resolvable. You just have to factor them into the timing and the mechanics. General rule of thumb is if the client expects that they won't get competition clearance, they won't pursue the deal anyway. So you just have to go through the process, but everyone will have done that assessment in advance to determine whether they anticipate there shouldn't be an issue. So what's an auction process? An auction process is the competitive process I was referring to. Essentially, seller puts an asset up for sale and they invite bids. That's usually run by a bank the investment bankers who will run the sale process. And there's a couple of limbs to it. One, as a bidder, you will usually sign a confidentiality or non-disclosure agreement. That's the document that's referenced later, which is a document between the buyer and seller to ensure that all the info that's disclosed to the buyer is kept confidential. And it usually contains some form of exclusivity as well, which we can jump into exclusivity next. Let me finish this point on confidentiality. So they'll sign the confidentiality agreement and NDA. Then as a buyer, you'll be given access to information. Usually it's in what's called a data room or a virtual data room. So you might hear references to something called a VDR. That's a virtual data room. And that's basically an online platform where lots of information about the business is made available to you as a buyer so you can review and diligence the business. And you're reviewing and diligencing it with all that context I was talking about earlier. All the context of those commercial drivers will dictate how you review and assess the business. As part of that, you will then provide your bid terms. So you will provide the financial terms of the business, and you will also provide the terms in relation to the equity term sheet, and that will form part of the business. You will usually also provide an auction markup. So the share purchase agreement or asset purchase agreement, the primary acquisition document, there's usually a version of it that's made available to bidders. They are usually very seller friendly. And so as part of your bid as a buyer, you will also mark that document up. So you'll submit your bid, which includes the terms and includes the markup of the purchase agreement and includes the price. And how do we assess price? Diligence will help assess the price because it will help you identify the things that may have an impact on price. For example, if there's litigation or there's a huge tax liability and you're acquiring a business with a huge tax liability, then that could impact price. So your price will be informed by the things that you've identified as part of your diligence process. So you've submitted your bid, you've reviewed the company, you've submitted your bid. What's next? Exclusivity. So what will happen is usually the buyer and seller will sign an exclusivity agreement, which basically prevents the seller from continuing a sales process with other parties in parallel, which buys a window of time for the buyer to get to signing. Why is it that the bidder wants an exclusivity agreement in place? If I'm going to invest lots of money in getting lawyers and financial advisors and tax advisors to all do all this work to get the business to signing, I'm racking up a lot of cost. I want to ensure that I'm doing that so I can ultimately acquire the company. So you want to make sure that you're getting exclusivity. So all of that cost that you're incurring is to achieve an end, and other people aren't also doing it in parallel to you, where you could potentially lose out. A key role of a trainee to flag, or a junior, Exclusivity has expiry dates, and so the trainee is always tasked with making sure that everyone's calendar is up to date to remember when the exclusivity period will expire. Often parties will look to extend it so they can get there to signing, because it doesn't always fit within the time periods, but that's a key role for a trainee to track. Diligence. Let's go a quick overview on some of the things to think about from DD. Declan, do you want to run through?
Sure, thanks, Kenan. Not to sound like a broken record, so I won't beat on this point too long, because I know that Kenan kind of addressed some of this partially in the previous slide. But what is due diligence, right? It's arguably the most, if not one of the most, like important stages of a private equity transaction, right? And at a high level, it involves a detailed investigation to the target company to kind of understand the business, identify any risks or issues that could impact the value, structure, or even like the timing of the deal, right? And it's important to know that diligence isn't one-dimensional. People just think like, oh, due diligence is only a legal thing. It's most certainly not. It covers a range of work streams, right? It includes financial, tax, commercial, ESG, data privacy, IT, and they're all usually provided by separate service providers, right? Like financial could be done by an investment bank. The tax DD could be done by one of the big four, right? And it's important that isn't overlooked, right? Like, because from a legal perspective, we usually review areas like material contracts, employment arrangements, regulatory compliance, IP, litigation, things like that, and other items that Kenan has previously touched on. But we also can't forget about the other things that the client really cares about. And this kind of leads on to the second point, right? Like, one of the first things that we need to do at the outset, before even starting the diligence process, is to agree the scope of the diligence review with the client. Like, what does the client want us to look at, and how deep do they want us to look at it? And it's crucial that that's agreed beforehand so that we know what we're looking at and what the commercial and financial advisors are covering. And we need to ensure that there aren't any gaps, right? Because I think sometimes clients assume that lawyers are looking at things, which in reality we're not. And that actually sits in another advisor's ballpark. And part of our role is to make sure that everything the client cares about is being covered. And I think linking to that, right, like the nature of how this DD is going to be provided to the client, that is also usually agreed with the client from the outset. So some clients want a very detailed commentary style report, but most commonly in PE transactions, and as Kenan mentioned, just given the speed that these transactions can sometimes go at, they usually prefer shorter kind of red flag reports that focus only on the key issues. They want a rank of their seriousness and a suggestion as to next steps and remedial actions moving forward. And then from that, sometimes you can take a red flag report and make it slightly more detailed for other purposes like W&I insurance or bank financing. But there are work streams that are later down the line. And I think from the outset, usually what we find is that clients just want a red flag straight to the point. What are the issues with this company, and how do we take action to make sure that we're kind of apportioning the risk correctly between the buyer and the seller? So as Kenan kind of mentioned, in practice, what does this look like? How does it work? Well, the buyer will get access to the documents and the relevant affairs of the company via a VDR, or a virtual data room. And the buyer's lawyers will usually prepare a due diligence request list, right? Or an information request list. Sometimes it's referred to as an IRL. And that'll set out what information the buyer wants to see in the data room. And then alongside that, they'll usually run a Q&A process, right? So a lot of people think that due diligence is usually just like a one-time thing, and it kind of like, you do diligence for 3 days and that's it. Usually it's a process that can take a couple of weeks unless you're on an expedited timeline, right? But the Q&A process is there so that, and it's really important, right, that we keep a live Q&A log throughout like the diligence process, because what you don't want to happen is that you conduct a little bit of diligence in the first week, find out a couple of issues, you run the Q&A process with management or the sellers, and they address the point, but then come week 3 when diligence is finishing, you find another issue, but then you find out that the Q&A log is kind of out of date or it's already been closed. You've got an issue there, right? You've got to reopen things. It causes delays, incurs cost, and that's not what we want. So it's not a one-off exercise. You keep a live Q&A log, you keep updating the information request list, and consistently trainees will go into the data room, see what's been added, and may even take a first cut, right, of kind of looking through these documents and seeing where any potential red flag issues are. Now, as Kenan kind of briefly touched on as well, in auction processes, and usually to assist with the buyer's review, sometimes we will see a vendor due diligence report, or what is usually kind of abbreviated to VDD. That's prepared by the seller's legal advisors to assist with the sale process and to kind of give potential bidders an overview of the business and the key issues, right? It's there to streamline the process. It gives the buyers already a heads up of where potential issues already lie, and kind of just a broad overview of what the company, of how the company is kind of conducting its business. And from a buyer's perspective, that can be very helpful, right? However, on the flip side, there are some important points to watch out for. So you should really be checking the date of the report, of the vendor due diligence report. You don't want it to be too out of date. Otherwise, I mean, we'll have to conduct top-up due diligence, right? You don't want something that was once irrelevant to have since become relevant, and therefore we have to kind of tackle it there. Equally, we want to try and find out whether we can place reliance on the report, right? Like, can the buyer rely on the seller's VDD report so that if anything in there is misleading, inaccurate, misrepresented, is there potential legal recourse by the buyer being able to rely on it and potentially, getting a claim for damages if there were any issues with the report later on? And then, I mean, even in the ideal case, there isn't any issues on those two fronts. Regardless, buyer's counsel is always going to want to kind of independently verify some key facts, right? We're not always going to take the seller's word for it. And it's important that we're still checking the very key areas that the client wants us to focus on. And it's these reports, right? Like, once the legal diligence review is complete, the findings are pulled together into a red flag report or something a bit more comprehensive, and they're then given to our client. They then kind of do an in-the-round review, and it directly informs the buyer's commercial decision-making. So, for example, whether to proceed with the deal, adjust the purchase price, or require specific contractual protections like an indemnity. And that feeds straight into negotiations of the SPA, and particularly the warranties, indemnities, and disclosure process, which Kenan will speak to you about in a moment, unless he has anything to add to this DD section, Kenan.
Yeah, I think the only thing to add is what I would think about is, in terms of a good diligence report, is, so as Declan set out, there's a recommendations. The key thing, and sometimes a bad diligence report will just summarize the business and summarize the issues with the business. The key thing with a good diligence report is it always tells the client why the client should care and recommendations for remedial action that the client can do to address those things that we've identified as things they should care about. So that should always be the aim. So whenever you're doing diligence, the one thing you should always ask yourself when you're doing it is, why should the client care? And explain to the client why it's relevant to them. Whether it's a risk point, whether it's a price point, whether it's a timing impact point, why should the client care? Explain to them why the issue is relevant to them. I guess, yeah, moving on to the SPA. I'm conscious we're probably running a little bit behind, so I'll try and spin through quickly. As it sets out here, the SPA, which I explained before, has two primary functions. It transfers ownership of the shares in the business. I'm buying the business, so it does the job of selling the business to me, and it allocates risk between the parties. So what are we talking about risk? What happens if competition clearance doesn't come through? What's the impact for the buyer and the seller? For example, if we're buying the business in March, but the accounts, which were the basis for which we assess the business, are prepared in January, who is bearing the risk for the interim of the business from that account date? So the whole function of the SPA is to sell the business and allocate the risk between the parties. So who prepares it? Ultimately, it just depends on the deal dynamics. It can be prepared by the buyer or the seller. In an auction process, you'll typically see a sell-side draft, quite seller-friendly. On the flip side, sometimes sellers don't prepare a draft, as if it's not a very competitive process in particular, a buyer can do the buyer draft. Obviously, whoever does the first draft tends to draft the document in a more aggressive way to suit their client, buyer or seller. And as I set out before, depending on the deal dynamics, it will impact whether you'll do a very fulsome markup or whether you will target those things that the client is particularly concerned about with respect to certain liabilities and not amend terms relating to some others that they're not particularly focused on. It all depends on the dynamic. Key things to think about: parties. It sounds relatively self-explanatory, but you need to make sure you understand who all the shareholders of the company are and make sure they're all the people selling under the SPA. That's not always the case. Understanding what shares are being transferred. Do they translate to the whole ownership of the business? Pricing dynamics. So the reference here to earn out. So it's not always the case that you pay for 100% of the consideration for the business day one. Sometimes you will have The majority of the consideration paid one, with a portion left for an earnout. So if you hit a certain profit or turnover return year on year, they get paid more consideration. Why? Particularly in a founder context business, it will keep the founder interested in staying with the business because they can get more consideration if they hit those metrics, and it encourages an alignment between buyer and seller. The typical private equity to private equity seller usually won't have an earnout. It will just be a clean exit, as we refer to, where the whole business is acquired for all of the consideration. Escrow, you sometimes see as other sort of things to think about. So as Declan was referencing, you do diligence, you identify stuff, that impacts the SPA. Maybe, for example, that you identify ongoing litigation. Now, you could either price ship for the litigation, won't make you very popular to the seller, or what you could do is you could agree an escrow, where you say, if the claim is unsuccessful from the claimant and the business therefore doesn't have to pay out, then the escrow money is effectively money held pending, then the escrow money will be released to the seller and they will get the money. However, if the claim is successful against the company and the company has to pay damages to settle the claim, then that money isn't paid to the seller because effectively the value of the business has been impacted. So you can have escrow arrangements to deal with potential contingent liabilities that haven't crystallized. Similarly, it also includes provisions related to termination. Both parties will want to be very clear about the timings of the deal. You don't want this document to say, I'll sell to you, you'll buy from me, TBC when that happens. There will usually be something referred to as a long stop date, which is if we don't close by this time, both parties walk away. And so that sort of sets the dynamic and the timings in the document. There's a reference to here restrictive covenants. Those are sort of contractual protections, and usually what they're doing is they're restrictions on the seller from poaching customers, hiring staff that are needed to run the business post-close. Because the last thing you want is the seller has a great relationship with management, you buy the business, immediately after the business is sold, the seller steals all of the management and they basically rebuild another business again that's identical to the one you just bought, and now you're competing with the seller's new company. So you have those provisions in place. And then it also has, frankly, very boring but essential things referred to as deliverables. Are those the share certificates for all the sellers? Do you have the share certificates so you can cancel them so there's no certificate of their ownership? The stock transfer form. Everyone talks about the SPA. It's heavily negotiated, but the stock transfer form is essentially one page, and it's the one thing that operates the transfer of the shares from the buyer to the seller. It's a very boring piece of paper, but it's probably the most instrumental. You could technically do a whole deal with just a stock transfer form. That's a deliverable. That's the kind of thing that's governed in the deliverable section of the document. Another thing that's very important deliverable is the consideration. So you have a whole section that says at closing, buyer has to deliver this, seller has to deliver that. And the seller will usually have to deliver stock transfer forms transferring the shares, and the buyer will have to wire the money. So that will affect the purchase, and the seller gets the money for the shares. So it essentially regulates the mechanics of the business, it affects the transfer of ownership, and it allocates risk between the parties. Other documents, just to run through. So we touched on this already around something reference to a warranty deed, and we talked about diligence and disclosure. So just a sort of scene set. What are warranties? Warranties are statements of fact about a business. And so there are two key buckets that everyone should focus on when they're buying a business. There's fundamental warranties. And what are those? Those relate to the seller's ownership of the shares, their title to the shares, and their authority and capacity to sell them. I am a seller, I own these shares, and I have the ability to sell them to you. That's a fundamental warranty. Business warranties are warranties that relate to the condition of the target business. So warranties around its financial position, warranties around these are all employees, there's no employee disputes, these are all our key customers, there are no disputes with our customers, this is the intellectual property we own, this is where our factories are, this is the real estate we own. These are all statements of fact around the business. And that provides the basis on which the buyer will acquire the company. What's unusual in a private equity context is the business warranties aren't given by all the sellers. The business warranties are given by management. So remember what we were referencing earlier about how management run the business? That's the key point. They understand the business day to day. So the managers give the business warranties, whereas all the sellers will give the fundamental warranties in relation to the shares. What does that do? Number one, is because the private equity firm isn't in a position to give the business warranties because they don't know the day-to-day running of the business. But two, it also provides them with the ability to have a clean exit from the business because they're not giving warranties around the complicated day-to-day operations of the business. They're only saying, I own these shares and I can sell them. So it facilitates a clean exit. And if you're a private equity firm, you're taking investors' money in, you're putting it into a business, you sell it for return, you want to be able to get that money back to your investors. So you're always focused on a clean exit. That's the context, and that's why it matters. The warranties are usually qualified. So some things are qualified by the seller's awareness. So far as the seller is aware, it's not like, it's not currently under investigation. Maybe it is under investigation, but they haven't had notice of that yet. So far as they're aware, they're not under investigation. So you can qualify warranties that way. Liability for warranties are also usually time limited. So when you give a statement about warranties of the business, if I'm a buyer and those statements are untrue, I can bring a claim. Usually there's a time limit. I only have 12 to 18 months after acquiring the business to bring that claim. If I don't bring a claim within 12 to 18 months, then that's time stamped. And that's all to do with this clean exit point. Other than tax claims, which tend to run for the tax liability period, which is sort of 5 to 7 years. The other feature that is very unusual to private equity are the financial caps on liability for warranties. And so what does that mean? Because management are usually giving the warranties in relation to the business warranties, it is pretty typical in a private equity deal for there to be something called warranty and indemnity insurance, or in the US, it's often called rep and warranty insurance, representations of warranties. Fundamentally, they're the same thing. So all those warranties, all those statements of fact given in relation to the business, in respect to which a buyer can give a claim, they're backed by insurance. So what happens? Buyer buys the business, they realize this piece of IP that was alleged to be owned isn't owned, the buyer wants to sue. The buyer will bring a claim. But management, what will happen in practice is management are only on the hook for the warranties for £1 or $1. So they don't really have any liability in respect to the warranties. And instead, the recourse to the buyer will be under the warranty and indemnity insurance. So they bring a claim and they will recover under the insurance. So that's pretty typical structure for a private equity deal. And why is that the case? One, again, it's this point around a clean exit. But two, again, if I'm a private equity firm, and there's a breach of warranties, but it's management who run my business, you also don't want to be in the business of litigating against your management while they're also simultaneously running your company. So that's two. One, it provides for quick and easy recovery under insurance. Is three, and then you can price for it. You understand the risk. You say, this is the cost of a policy. You build that into the cost of doing the deal. And then you have the ability to recover under insurance. It provides for a clean allocation of risk and facilitates a clean exit. So that's some of the context of why there are facets to a private equity transaction and the typical way private equity deals are done, which is different to a normal M&A deal. The one caveat to this insurance point is, more often than not in the European market, slightly different in the US, the sellers will still stand behind the fundamental warranties. So the W&I insurance will cover the business warranties, the warranties around the business, but they won't usually cover the fundamental warranties. And so if I'm a buyer and the title to the shares wasn't true, and I sue, I will then be suing the seller, and I can recover 100% of the consideration I paid, is what you'll sue for. You'll sue for 100% of the consideration. Effectively, if I'm paying £1,000 a share to you for a share, and it turns out you don't own that share, I want that full £1,000 back. That's the kind of rationale. So, quick sum, fundamental warranties given by all sellers in relation to title, the sellers stand behind them, and they're not usually covered by insurance. Business warranties, they are statements in relation to the business. They're usually given by management. Management are on the hook for £1, and there's insurance in place. And if there's a breach, the buyer will recover under insurance. That's the summary of the main split. And in relation to that is just the disclosure letter. This is basically one way in which the warranties are qualified. Actually, I'll just sprint through it pretty quickly to give you an example. So if someone says, in the context of a business, there's no litigation. It's a statement of fact, there's no litigation in relation to the business. In any context, in any business, there's lots going on. There's usually some level of dispute. So a disclosure letter will say, here's the statement, there's no litigation, and the disclosure letter will disclose against those statements. So it'll say, other than there's one employment-related dispute in our Paris office in relation to this, there's one customer dispute in relation to late delivery of products in Sweden, it will disclose against the warranties. And so that's what the operation of that document is. Something's been disclosed to the buyer is made aware of it, and therefore obviously the buyer can't sue for it. What the disclosure letter does is, one, it forces disclosure. So buyers made aware of these issues up front, and they may need to make a price adjustment to address that, or they decide to walk away if it's very material. And it's a source of information in relation to the target. From a seller's perspective, it's a way of providing a defense against a claim. We told you about this, you're aware of it, and so the statements we've given in the SPA are qualified by this information. And the two key buckets you'll hear about are general and specific. General is you generally disclose things against the warranties. So often the data room, the whole contents of the data room might be disclosed against the warranties, but also, for example, things that are publicly available. You can do a search of a company's house, you can do a search of the courts. If you can find it publicly, that's deemed disclosed because it's available to everyone. Whereas specific disclosures are the example I gave earlier. Here is a warranty around litigation, and here is a specific disclosure about litigation we know about in relation to those warranties. So that's how they work together. I think we're probably coming up to time, so we won't run through these too much. These are really just to make you aware of the other kind of documents that are relevant, but I think we've covered the key points. I don't know, should we run through the trainee role? Otherwise, I don't know on the law career side whether we just jump to questions and people can, we can address the trainee role in the context of those questions.
Yeah, I'm happy to go over the questions and kind of link it to the trainee role if you think that makes sense and within the time as well. What do you guys think?
Let's do that.
Yeah. Cool. Let me just have a quick look. There was one question sort of training related is from Kenan as what's one thing you wish more trainees understood about how PE deals work in practice when they first join the firm, and what would you recommend they do to ensure that they're prepared beforehand?
Maybe I'll give you my insights as a trainee supervisor. So I always have a trainee. So this is what I'm looking for in a trainee. The good thing with it being a private equity practice is, even just look at this list, there's so many different work streams. There's so much to do. There is genuinely so much you can be involved with. And the good trainees really understand that a deal, they're intense, they move quickly, they can be complicated, just get stuck in. Have a really good attitude, volunteer, and realize that it's all a team effort. So if you're really a part of that team, that's the key piece. And so looking at this here, for example, so Declan was talking about the Q&A as part of a diligence process. You take ownership of the Q&A tracker. As questions come in from specialist teams, you add them, you send them to the other side so they can provide responses. Take ownership of that process. So if I'm a supervisor and I'm trying to negotiate the SPA, I can also turn around and say, hey, those questions we submitted yesterday, do we now have answers for them? And as a trainee, if you know the answer straight away because you've been keeping on top of that tracker, that's going to make everyone's life so much easier. So there's so much you can do as a corporate trainee. There's so much to be involved with. And so taking ownership of those work streams, that's the real standout.
Great, thank you. And sort of still relating to the trainee part, so I saw a couple of questions that are related about, what are the most important transferable skills a junior lawyer / trainee would need to be a successful, private equity lawyer down the line, and what skills or attributes most distinguish trainees who are able to, add real value early on.
Yeah, definitely. What about, instead of coming from a supervisory perspective, let's say, Declan, what's the one thing that you learn that you think is a good skill that all trainees should take away?
Interesting. I'd probably say the main key skill, right? And it's probably self-explanatory. I think a lot of people might expect me to say, but it's just to be organized. As Kenan kind of mentioned, right? Like there is a lot of work streams for you to be involved in a PE seat, and it's really, really important that you stay up to date on all of the updates to each one of those work streams. And I, at the time, always used to think like, oh, checklists, like pretty tedious work stream. Never really enjoyed like doing them. But then as I progressed, I kind of understood that these checklists are the heart and soul of like the work stream. And it is basically the main document that keeps us grounded as to where we are in the transaction. And it's probably the most important kind of ancillary work stream that we do, apart from actually drafting the main documents, to make sure that a deal goes from obviously its inception and then all the way to signing and completion. So I'd probably say organization is definitely probably the most transferable skill that I'd advise people kind of get familiar with before joining, and also once they have joined, just try and keep their inbox in shape and make sure that they're frequently kind of covering all forms of correspondence from whoever it is that they're in contact with.
Yeah, I agree with all that. So.
Great, thank you both. And as well, there's an interesting question from someone in the audience. They said that they saw on the firm's website that the time for closing a private equity fund has dropped from 32 to 18 months on average from 2024 to 2025, and they're asking, has this had a significant impact on your practice?
I guess I'm also maybe more for the funds lawyers who sort of work on the fundraisers. I guess they just have to work to a tighter timeline as one of them. But really, it also speaks to what we're seeing as a pattern in the market. There's definitely a movement and consolidation towards the larger, sort of more institutional investment firms, and there's probably less disparate, small to medium-sized private equity firms. There's much more consolidation. So people are increasingly putting their money in a smaller number of firms that are kind of safe bet and reliable, that are raising these much larger mega funds. So that's probably why we're seeing a much quicker timeline, is there's much more focus towards a fewer number of investment funds that are raising larger and larger funds in a very targeted way. So I think people are moving to a smaller spread of investments into private equity, and that's why we're seeing that timeline accelerate. What does that mean? From my perspective is, one, we tend to have increasingly significant institutional clients, and also why you see there's a huge investment right in the legal industry in terms of why lots of firms are building private equity practices, is because our clients are in the business of buying and then owning companies. So you have one global private equity client, they have a whole portfolio of companies that you can service, and they're also in the business of doing deal after deal after deal in the way that a large corporate often won't be. And then that consolidation means there's also a lot of intra-fund acquisitions at the moment. So the example I gave from the outset, where we advised EQT on its acquisition of another investment firm, we're seeing a lot more sort of bigger private equity acquiring smaller or more specialized private equity funds. And so that's also interesting from a transaction perspective. That's where we're seeing the movement. And that mirrors the trends we're seeing in all corporate industries, to be honest, including law.
Thank you so much for the detailed answer. And just maybe round off with two quick questions. One of them is from Tristan, and they asked, what would you say is the most exciting aspect of work in private equity?
I think the thing I enjoy most about private equity is ultimately the clients are in the business of sort of buying and selling companies. So you're always coming across different businesses. It's not the same thing over and over again. Every business is very different. The thing it does is very different. So that's always really interesting. You sort of learn about a new industry. Two, it maybe depends on your personality. I sort of like the fact that we're working to these timelines. You get the bid in, you try and get it done. It's a team effort, and it really feels like you're in the trenches together. You're sprinting together. It's a very collaborative, slightly intense, very engaged dynamic where everyone's working to the same goal. And I think the other thing I like is all of it's under the bucket of black letter law. Company law is critical throughout everything we do, but ultimately we advise less on a translation of statute and more of, in the context of the law and in the context of the requirements of law to affect a transaction. Ultimately, it's buy side and sell side. They can mutually negotiate the deal that they want between each other. So it's you work with the other side and you create the deal that you want. You negotiate the terms you want. They're usually both sophisticated parties for the kinds of clients that we come across. And so everything's up for grabs, everything's up for a discussion, and you can construct to be creative and find ways to get the deal done in a way that works for both parties, so that mutually achieving the same end, and the flexibility to do that.
Perfect, thank you. And kind of to round off with the final question, sort of to give advice to the attendees, and I think this will be nice maybe for both of you to answer. Looking back, what would you do differently if you were starting your legal career again with the aim of specializing in private equity / with Ropes and Gray?
Declan, do you want to take that first? You're closer to
it. Yeah, I think it kind of links to my organization point that I mentioned previously, but I think it's very easy that when you move into a PEC, it's very fast moving. There's a lot of complex work streams going on. I think it can be easy for you to get lost and kind of panic about things. And I think the main way that I dealt with this, and as I kind of gradually got more comfortable with the work streams that we were doing, is fundamentally, and you can do this either before you kind of start your training contract or during it, just as you're starting. what really helped me, and this especially helped when I was on secondment as well, and it was really important to kind of understand the entire kind of deal construct, is look at a timeline from like the very inception of the idea that a sponsor wants to acquire a company all the way to a closing, and kind of just have a general gist of kind of like everything in between and kind of what happens in each work stream, because you'll find yourself in situations where you're going to be kind of across multiple deals or multiple multiple kind of PE work streams, and you're not going to know exactly where you are. But as long like if, for example, one work stream you're doing due diligence, the other work stream you're about to hit signing, another one you're putting together the Bible because the deal is just closed. Like if you understand roughly what the timeline is, although you might not know specifically where you are as you're being roped in for the first time, you kind of roughly know where things are. You can kind of plan out how these work streams are going to kind of spin off moving forward. So I'd probably say, yeah, kind of get a general gist of the overall timeline of a deal. I think that's helped me immensely, kind of both it during my CM whilst I was on secondment as well.
And then what other things I would add is it's probably a similar point around not worrying too much as well. Don't stress. I think the thing with private equity is no one's expecting you to know all the intrinsic ins and outs with this high level of granularity. You've not had any huge amount of sort of practical working experience in that sector. That's fine. There are just really easy ways to kind of just build familiarity and learn more about it. Because most top private equity firms now have a podcast. Ropes has a podcast that talks about deals and transactions. A lot of law firms do. You know, as you're going to the gym or you're like going for your commute, whether it's to work or to uni, or you're going for a walk somewhere, or you're just making breakfast on a Sunday, you can just play something like that. Just build that gentle familiarity that will help you understand it contextually as a whole, instead of, I must learn everything about private equity now. Just sort of build familiarity and think about it that way. The other thing I would say is, for a firm like ours, and if you're looking at applying to firms, again, make your applications very targeted to the work that firm does and the things that it's known and it excels at. So most firms will do press releases to the extent they're permitted to for the deal, about the deal. So learn about the recent deals they've done, come prepared to talk about those in the context of an interview. Try and go to workshops, go and listen to things like this, speak to people, get a sense of what the culture and the unique facets of that firm are, and be ready to speak to those and identify those in your application and then your subsequent interview process. You know, for a lot of firms like us, the general statement is that, you know, you're good at M&A work. We have a good finance team. We have a global footprint. Those are universally true of us and all our competitors. So while you obviously need to know that doesn't show that you've researched our firm specifically, and that's the same for all the other firms that you would be applying to. You know, we're not naive that you're only going to apply to one firm. So really do your research and make it as targeted as possible to that firm to demonstrate, first and foremost, you've put in effort to understand that firm, and that's why you want to work there.
Thank you. That's excellent advice. And just to round things up, I'm just going to pop a final poll on the screen for the attendees, which is about their key takeaway from today. And just a reminder to everyone before you go, that we'll be sending out a link containing the recorded session, so please keep an eye out for that. There will be a survey as well popping up once this masterclass has ended, so please fill that in to let us know how you enjoyed today and then what other topics you'd like us to cover in the future. And then a reminder to all candidates that the 31st of January, or this Saturday, is a major vacation scheme and training contract deadline day. In fact, Ropes and Grey has a spring and summer vacation scheme deadline on the 31st, so make sure to check out LawCareersNet's deadlines page for all the upcoming deadlines. Links will be in the follow-up email, and I'll just drop that in the chat as well for you. Thank you to everyone who has answered for the poll. There you go.
Just to say thanks everyone, and good luck. It's a pretty stressful process.
Yeah, and again, remember to check all our other upcoming masterclasses that I mentioned earlier on the events page on LawCareersNet, and then post about this masterclass on LinkedIn so we can see how you found it. But thank you very much again to our panelists for this excellent session, and to everyone attending today. We hope you enjoyed, and yeah, we look forward to seeing you again next time. Thank you.